Hi there, this is Alvin from Dr. Wealth. You might have known that the stock market has been pretty bullish this year, even though at the start of the year, quite a lot of people were quite bearish this year, right? So S&P 500 proved the bears wrong and it's up 20% year to date, and it's just 5% shy away from its all-time high. So things are looking good for the stocks, and not only that, the other asset classes like gold has also surpassed $2,000 per ounce. This is not the first time that gold has surpassed $2,000. This is probably the third time, maybe third time lucky. It can manage to break all-time high from here onwards. And as well as Bitcoin has also crossed $41,000 and is definitely pretty bullish since the start of the year. It's more than 100% gain from Jan 1st, right? So things are looking good, and why are these assets moving up as they were? So one of the key things that people are betting on, or the market is betting on, is that they're expecting a rate cut, right? Because Federal Reserve has been increasing the interest rate since last year, and that has caused a lot of market turmoil in 2022, right? So this year, 2023, the rate hike has slowed down, and it was also paused since the middle of the year. So it seems like we are at the tail end of the interest rate hikes, and now people are betting that the Federal Reserve is going to cut rates. So the rate cut is expected as soon as March next year. Okay, so the very first cut people are expecting is about 0.25% cut, right? And that's based on the futures market of the Fed fund rates going into 2024. So now the market participant is front running this news, right? They're pricing in this expectation in today's prices. So that is what is happening, and hence some of these Bitcoin, gold prices have been rallying, because with a lower interest rate, USD usually weakens. And when USD weakens, the amount of USD that's required to buy an ounce of gold or one Bitcoin will have to increase, right? So hence the price per ounce, the price per Bitcoin has gone up in that, with the expectation of a rate cut and a weakening US dollar. And it's not just the market participant, even the major banks have made certain prediction or forecasts that the Federal Reserve would cut interest rate next year. And it's pretty aggressive the way that they made out this prediction, right? So like Barclays expected like 4 rate cuts, 0.25% each time, so up to 1% cut in 2024. And ING Bank expect 6 rate cuts and total 1.5% drop from current levels. And UBS is the most aggressive, expecting a 2.75% rate cut, about half, right? About half of current interest rate, right? By end of 2024. So you can see that the market is primed for this expectation, and which means does it mean that investors should now go into the market, be bullish and buy stocks and buy Bitcoin, buy gold in anticipation of this rate cut? Okay, so on contrary, it's actually a very risky thing to do, because statistically it has not been good when the Federal Reserve start to do its rate cut after a series of interest rate hike. Okay, so let me give you the statistics. Of course, Jerome Powell, the US Federal Reserve chair, has also came out and said that please don't expect a rate cut. Okay, but few people believe him, and they continue to price a rate cut going forward into 2024. Okay, so this is the statistics that I wanted to share with you, right? So this came from a Morgan Stanley study. So in the past 50 years, there were about 9 cycles of rate hikes. Okay, so 9 times the Federal Reserve have a series of interest rate increment, and then 7 of these 9 rate hikes, right? Eventually, when the Federal Reserve start to pivot, which means they start to cut interest rate, opposite to the rate hike, right? They start to cut interest rate. After they cut the first interest rate, 7 out of the 9 times that happened has caused the stock market to go down. And that statistics gives us the probability that it is very likely, if the Federal Reserve cut interest rate in 2024, it might not be good for the stock market, okay, statistically speaking, right? Of course, there's still that 2 out of 9 chance that it may not be bearish, right? But you can see that the odds is against a bullish stock market if the Federal Reserve cut rates. So that means that it's actually not a good news. Okay, cutting rates intuitively is good news for stocks, right? But somehow statistically have shown that the very first rate cut is not a good thing. Okay, and this is further statistics that I got from another place, and this shows that on average, when the Federal Reserve pivots, it will decline by about an average of 28% for the S&P 500. Right, that is a big drop. Okay, that is a double digit, almost 30% drop from where that pivot starts. Okay, and it will last around 14 months before the stock market bottoms. Right, so which means the next rate hike might cause a stock market crash. Okay, so we are not out of the woods yet, and this is another diagram to show you, and maybe let me enlarge this for you. Okay, so this is the S&P 500 chart, and you can see that there are green dots and red dots. Okay, so green dots is when the Federal Reserve has increased the rates, and the red dots are the times where the Federal Reserve has cut rates. Okay, so let's focus on the very first red dot after the series of green dots. So that is the very first rate cut, correct? So for example, in around early 2000, you can see that after the first rate cut, okay, the S&P 500 actually fell. Okay, same as in 2008 during the great financial crisis, right? The first rate cut was about the peak of the market, and then the stock market started to fall. And then come the period, okay, so this is until 2020, right, which is a post-COVID period, right? We can see that in that case, it didn't work because the first rate cut actually caused the stock market to rally. Okay, so there are times that it didn't happen, there are times that it happened, but most of the time, based on the history, right, the past 50 years history, the chances that a first rate cut causes a crash is pretty high. Okay, so I don't bear good news on that. And of course, a rate cut is more like a reaction. It's not right to say that, oh, because of rate cut, that's why the stock market crashed. Okay, so actually we should not link it that way. The rate cut is a reaction to something. Right? It must be something that's bad in the market that caused the Federal Reserve to cut interest rate. Otherwise, why would they cut interest rate out of nowhere, right? It could be a recession, right? And that's the thing that people has been talking about for the longest time, recession, but the US seems to be able to dodge this recession for a long time to come. But that doesn't mean that it's totally out of the woods, right? Recession may come in 2024, and that may force the Federal Reserve to cut the rates. Okay, so which means the stock market might be reacting to the bad news, which is recession in this case, and not because of the rate cut. The rate cut is in response to the bad event that is going to happen. So hence, that is the relationship, right? So it's not the rate cut that causes the stock market crash. It's usually a bad thing that causes the rate cut, and then the stock market will react to the bad thing as well. Okay, so that is the whole relationship, and which means that the hard landing possibility is not totally gone. Okay, and of course there's also a possibility of soft landing, right, which I'll talk about it later. So I do think that a recession is still pretty much in the cards, because this is the U curve inversion, right? So which means that if the curve is below, the graph is below the horizontal line, which is the 0% line, right, which means the U curve inverts. Okay, so what is the significance of that? So whenever the U curve inverts, recession usually follows. Okay, again, historical statistics have a very high probability. U curve inversion typically leads to a recession. All right, and another thing that I observed is that when the U curve started to turn positive, right, from negative to positive, right, which means they uninvert, and that is usually where the recession will happen. Okay, that happens in 1990, that happens in early 2000, and that happens in the 2008 financial crisis, as well as during COVID. Okay, so in the past 4 recessions, this phenomenon has held true. And now we can see that the inverted U curve is ticking up again. It's going to uninvert itself. So we might be really at the cusp of a recession in 2024. So that is another sign that I think it might not be good news going forward into the new year. And despite that, the GDP growth for US has been strong. In fact, the last quarter has been a surprise, right? It has grown 5.2%, and which means the GDP growth has not slowed down yet. Okay, and if something bad happened in 2024, again, this will catch a lot of investors unaware as well. And this is the unemployment rate is also at all-time low, right? So it didn't spike up. So far the economy looks resilient, and hence people are talking about a possibility of a soft landing. Without a recession, the Federal Reserve was able to bring down and tame the inflation to a much more comfortable level. Okay, so it is very unpredictable, right? If let's say a soft landing happens, means that a rate cut is not needed, and that means we can avoid the very first the curse of the very first rate cut that caused the stock market to go down. So if we can delay this, if it's really a soft landing, then I would say that the stocks would have more legs to run. Okay, so that is something that we can't know at this point in time, because prediction is never accurate. And if it's a hard landing, then I would say that instead of stocks, bonds, gold will perform better, right? Because if they really have a rate cut, that will cause the bond prices to go up. Okay, because bond prices and interest rate will react negatively to each other, right? One goes up, the other will go down, so they're inversely correlated. So for the longest time, stocks and bonds have always been non-correlated, and the problem is in recent years they have been pretty much correlated. Stocks go up, bonds also go up. So this, if a recession happens and a rate cut happens as well, it might cause the non-correlation relationship between the stocks and bonds to continue. Okay, so which means stocks go down and bonds will go up. So hence I say that if there's a hard landing, actually it's better to buy the bonds rather than the stocks, as well as gold, because if they cut rates, the USD will weaken and gold prices will go up in response as well. Okay, so which way, right? I don't know. Okay, it's very hard to predict, and I definitely would prefer to be more reactionary, right, rather than relying on certain prediction, because a lot of times prediction don't go right. Okay, whether it's a economist with PhD making a lot of predictions, or very seasoned banker, a lot of times I've seen that it's almost as good as a coin flip, right? It's a 50-50 guess. Okay, so I'm not going to make a guess whether it's a soft landing or a hard landing. I'm still pretty much invested in stocks, and I will continue to do so. And one approach is being reactionary, is that we can use certain technical indicators, like for example, if the index or S&P 500 goes below its 200-day moving average, usually that may be a sign of a greater crash to come. Okay, so that's where we can further decide whether we want to go light on stocks, right? Hold more cash at that point in time, more defensive posture. I think that is a more prudent way, right? Be reactionary rather than using our prediction, because prediction is not accurate enough for us to rely on and bet our money on as well. Okay, so hope you have a better understanding, right? The very first rate cut may be a curse. Okay, so don't be too happy that people think that rate cut means a bullish stock market, right? We have been trained in that sense. Okay, the very first rate cut is not, but subsequent rate cuts, yes, eventually the stock market will recover. Okay, but the first rate cut, we need to be very careful about that. Hopefully you have a better idea, right? Thanks for watching. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.